So the Tax Act has a lot of beneficial aspects and has a few negative aspects. One of the key central aspects for high net worth individuals is the reduction in the top tax rate, down from 39.6% to 37%. The rate brackets themselves are also reduced. So what we're finding is that these reductions are very beneficial for high net income taxpayers. Where individuals seem to benefit the most are scenarios where they may have actually trades or businesses that they generate profits from, because the new Tax Act actually has a provision, let's say for a sole proprietor that earns a lot of profits, wherein they would get a 20% tax deduction on the profits associated with that business. So imagine a sole proprietor that makes $1 million of income. That sole proprietor could get a $200,000 tax deduction. So when you factor that into their taxes, along with the lower overall rate brackets themselves, it turns a 37% bracket all the way down to like a 29% bracket for those individuals. Now, the 20% deduction doesn't apply to all types of businesses. Specifically, it does not generally apply to many service types of businesses. So for example, a law firm would not qualify for this 20% deduction unless your income, your profit from that business was below a certain threshold. And that threshold is $315,000 for a married couple. I really believe that the biggest pitfall for individuals with the new Tax Act, objectively, it's the loss of the state tax deduction. So imagine if you were to have an individual that was making, let's just say they were making $1 million of income and they paid $100,000 in California taxes, for example. That $100,000 would basically be deductible against their federal tax return, and they would be able to reduce their federal taxes by, let's say, $40,000. That is no longer available. So for individuals, the manner in which they basically take their income is going to become a significant item. So, for example, let's say that an individual is a partner in a partnership and they receive what are called guaranteed payments, which is a kind of salary for partners in a partnership. Well, guaranteed payments are not eligible for the 20% deduction. If that partner instead received pass-through income, profit allocations, that profit allocation would be entitled to the 20% deduction if the business qualifies. So those are the kind of planning opportunities that individuals need to be looking at to make sure that they take advantage of these new tax laws. So what I really recommend that people do is go see their tax accountants, because it is a very complex code, the new code, and every fact pattern can be different. So I have literally prepared probably 25 tax projections for individuals based on the new tax law. And in each and every case, the maneuvers that we are making to sort of plan for and attempt to reduce their tax liabilities based upon the new tax laws is different for each and every person. The estate and gift tax rules have changed, and the exemption amount has been doubled from roughly $5.5 million to $11 million. And so the individuals need to take a look at their estate planning, because this increase for estate tax purposes is temporary. It expires in 2025. Therefore, if individuals were contemplating making gifts to other individuals, they need to consider doing that before 2025. Otherwise, the law reverts back to the $5.5 million threshold plus inflation adjustment.